This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Now, before we go into the content of Chapter 22, there's a little bit of revision and a little bit of new stuff that we need to deal with first, so that we'll then better understand the issues that are at stake when dealing with groups of companies. Now, the first bit of revision that we need to look at is here, Chapter 16. So don't panic, we are going to be dealing with Chapter 22, but a little bit of basic revision to begin with. If we just scroll down in relation to this first page on Chapter 16, we had our definitions of what was a period of account, chargeable accounting periods, and then financial years. And when dealing with financial years, we said that as from financial year 15, and there we have it, financial 15, starting on the 1st of April 15, going to the 31st of March 16, that from that financial year 15, there is a single 20% rate of corporation tax that now applies to all companies, irrespective of the level of profits. Prior to that, we do not have to know, it's not in our syllabus, but prior to that, depending upon the level of so-called augmented profit, a company may be small, it may be marginal, it may have been large, and therefore would have been paying tax at different rates. Therefore, when it came to the use of losses, back in the good old days, we were trying to ensure that losses, like they would in income tax, would take out profits, income in income tax, but profits for companies, would take out profits that would have been taxed at the highest rates of corporate tax. But that has gone now. There is only one single rate. So the issue of relief at highest tax rate is a thing of the past, at least so far as our syllabus is concerned. But with that introduction of the single universal rate of corporate tax, it's still going to be necessary to use what is now the profit limit of 1.5 million to determine whether or not a company will be required to make quarterly instalment payments in relation to the payment of its corporate tax due in relation to any individual chargeable accounting period. Now then, what we saw, and you'll see it here, is how we would determine whether a company was liable to pay and make quarterly instalment payments. What we did not say is what was the structure of that quarterly instalment payment system. That lies in Chapter 23, which is where we'll go in a few minutes' time once we've reminded ourselves about the issue of determining whether a company will be large for the purposes of making quarterly instalment payments. So we define here what we mean by a large company whose profits exceed 1.5 million. This was a term that we used to know as augmented profit back in the good old days, but now simply profits which exceed 1.5 million. Profits are defined as, well, we know what the TTP of the company is, our taxable total profit, plus franked investment income, or FII. What was that, remember? That was simply the gross equivalent of dividends received there. How do we gross them up? Times 100 over 90. We excluded, however, in that definition of FII, dividends received from related 51% group companies. And we then defined what we meant by related 51% group companies. Basically, if a parent company has a 51% subsidiary, they're related 51% group companies. If the parent has two or more subsidiaries, then all of those companies, co-subsidiaries with their parent, are related 51% group companies. The only companies we excluded from that, dormant companies, of course, were excluded. Now, the relevance of that profit limit of 1.5 million is that it exists for a single company, therefore not applicable within a group, and where that single company has a full 12-month chargeable accounting period. Therefore, in a group, we have to divide by the number of related 51% group companies. Now, again, given that a group structure may change from one accounting period to another, we included those companies that were related 51% group companies at the end of the immediately preceding accounting period. If, of course, we had a short chargeable accounting period, then we had to time apportion that limit as well, short being less than 12 months. We then did that example here at the on the first page of chapter 16. Large Limited prepares its accounts the 31st of March, and for the accounting year ended 31st of March 16, so it's a full 12 months accounting year end. Had a TTP of £600,000 and also received dividends from a number of companies, including its 2 wholly owned subsidiary companies. This was its lowest profit recorded in several years. So again, profits had been higher than this in previous years, the significance of which we will see in a moment. As Large Limited has 2 subsidiary companies, there are therefore 3 related 51% group companies, the parent company and its 2 51% subs. 3 related 51% group companies. What will we do with that? Divide the profit limit of 1.5 million by the number of related 51% group companies. That is 3. 1.5 million divided by 3 makes it 500,000. Large Limited has a TTP of 600,000, so even without including FII, analysing what dividends received would be classified in their gross form, i.e. times 100 over 90, as FII, and what amounts of dividend came in from subsidiaries which would not be so included, without even worrying about that, we know that the company is therefore large. Now that means that it will therefore be required to make quarterly instalment payments to settle its CT liability for the accounting period. We know that because, as we're about to see with the detailed rules of quarterly instalment payments, that given that this was the lowest profit that it had experienced for some years, it means that the company must have been large in the previous period. And only if the company was large in the previous period and is then large for the current period must we then make quarterly instalment payments in relation to that current period. Now back then we said see chapter 23. At the moment we don't understand what timing difference there is between a company that does not have to make quarterly instalment payments and one that does. We're about to see when we turn to chapter 23 how much more quickly we have to pay corporate tax if we are indeed classified as large for purposes of then having to make quarterly instalment payments. So what I need you to do now therefore is, having looked through that note as regards when quarterly instalment payments are required, to then turn our attention to chapter 23. So again, if you just pause at this point and we'll look at chapter 23 together, find out more about quarterly instalment payments, and then eventually we'll end up with the destination of this particular recording, chapter 22. Okay, chapter 23. Now, we're not looking at all of this chapter at this particular point in time. We're looking at one specific area, and that is when companies must pay their corporation tax. Now, that's picked up here in relation to Note 1.2, the payment of tax. Companies, to begin with, we're told, like individuals, must pay tax by the self-assessment system. It's self-assessment. So companies are required, therefore, to submit their own corporation tax returns and settle then the corporate tax liability based on self-assessment. It's their responsibility. They don't wait for the HMRC to tell them you owe us this much tax. It's down to them. So companies pay tax by self-assessment. Estimated tax is payable 9 months and 1 day after the end of the accounting period. That therefore is your normal due date. Now that applies in the absence of the company being classified as large and then having to make quarterly instalment payments. The normal due date is 9 months and 1 day after the end of the accounting period. So if, for example, we were dealing with the year ended 31st of March 16 and the company was not required to make quarterly instalment payments for that period, the due date 9 months and 1 day after the end of the accounting period. that would put it through to the 1st of January 17. So at that date, we must settle then our corporation tax liability for the year ended 31st of March 16, 9 months and 1 day after the end of the accounting period. But, as we have kept saying, there are then provisions that apply in relation to companies that are required to make quarterly instalment payments, and these have historically been known as large companies here. Payments, by the way, must be made electronically. All of it these days is electronic, of course. That is a requirement. There's no longer any sending them checks or anything like that. It has to be done electronically. Interest will be due to the HMRC on any tax paid late and will run from the due date to the date of payment. So if we miss that deadline of the 1st of January 17 by which to pay the corporation tax, then interest will fall due and will run at a rate of 3% per annum. Had we overpaid the tax, we made the point here, estimated tax. Now, in all honesty, by the time you get to 9 months and 1 day after the end of the accounting period, you should be pretty darn certain about what that CT liability will be, subject then to agreement of your computation by HMRC. But sometimes, of course, things happen and we may not have finally settled it. There may be contentious issues that we still need to resolve, so we pay based on an estimate at that point. It may transpire, therefore, that either we've under or overpaid. If we've overpaid, then interest on overpayments will run from the later of the due date or the date the tax was actually paid. But this time, note intriguingly, if we underpay, we pay interest at a rate of 3%. If we overpay, they pay us interest at a rate of 0.5% per annum. Isn't it great when you can write your own rules there? Under self-assessment, interest on tax paid late will be deductible against interest receivable, and interest received on overpaid corporation tax will be taxable as interest receivable. Now, normally, you don't yet know the rules. If you're going through this in the order in which I've suggested you deal with the chapters, we don't yet know the rules for income tax for individuals, but there, if there is interest that is payable to HMRC on late paid tax, that is not deductible against income. And if you have interest income from HMRC because you had overpaid the tax, then that is not taxable income. But so far as companies and corporate tax is concerned, any such interest payments, whichever way they go, company to HMRC, HMRC to company, they go through your interest income assessments. It's part of what we know as our non-trading loan relationship rules. It goes through the interest income assessment. So as long as no quarterly instalment payments are due in relation to the end of the accounting period, it's a simple scenario. The tax falls due 9 months and 1 day after the end of the accounting period. But quarterly instalments apply to what we've always known as large companies, now simply companies that have their profit figures in excess of their relevant profit limit. Large companies want with a profit exceeding 1.5 million. We know that's the profit limit, but it's based on the company being a single company, not in a group, so with no related 51% group companies, and of course it's based on a normal full 12-month length chargeable accounting period. That limit, as we've just seen back in chapter 16, must be divided by the number of 51% related group companies, hence the relevance for chapter 22 of groups, which is where we're leading to, and not only divided out by the companies, but if it were a short accounting period, one of less than 12 months, then we must time apportion that self-same profit limit itself. Now, if a company is required to make quarterly instalment payments, then it's going to be based on an estimated liability for the current year, the current accounting period. We'll see why it must be an estimate, because we have to start making those payments before the end of the accounting period to which we are actually computing our tax figure, before the end of the accounting period. You will not yet know the TTP, but if we're estimating that we're going to have profits in excess of the profit limit, and we were also large in the previous period, we had their profits in excess of the profit limit, then for this period, then quarterly instalment payments will fall due. They're quarterly, so fairly obvious. They are 4 quarterly instalment payments, and they'll be made at 3-month, i.e. quarterly intervals. But they're made to begin with in month 7, before then 10, 13 and 16, following the start of the accounting period. And within those particular months, the due dates are on the 14th of the month. So within an accounting period for which quarterly instalment payments are required, you've got to start making those payments on the 14th day of the 7th month from the start of the accounting period. Now you look at the timing difference here between when non-large companies that do not have profits in excess of that profit limit, when they would have to pay their tax for the year ended March 16, the 1st of January 17, 9 months and 1 day after the end of the accounting period. Compare that now with your due dates under the quarterly instalment payment system. Thus, again, for the accounting year ended 31st of March 16, when would our first quarterly instalment payment fall due? Now, the year ended 31st of March 16 began on the 1st of April 15. So we have to pay on the 14th day of the 7th month from the start of the accounting period. So start counting through from April, therefore, of 15, and then when you get to October 15, that is the 7th month. So on the 14th of October 2015, you will have to make a quarterly instalment payment, which of course will be 1 quarter of the estimated liability for this accounting period. That will be followed up by further quarterly instalment payments, obviously then at 3 monthly intervals. The next one will be due January the 14th, April the 14th, and July the 14th of 2016. Now you look at the difference between when those quarterly instalment payments have to be made and when you would normally make your annual payment on the 1st of January, there 17, 9 months and 1 day after the end of the accounting period. Compare that with your first due date, the 14th of October 15. You start making these quarterly instalment payments nearly 15 months prior to when you would ordinarily pay your tax. Now that is a huge cash flow effect. We're going to pay October 14th, 2015, January 14, 2016, April 14, 2016, and July 14, 2016. We will have finished making those payments by July 14, 2016, which is, well, just under 6 months there before when you would otherwise have had to have made that total payment. This is going to have a serious cash flow effect in relation to the company. Quarterly payments are not required if the current profits, we used to call them augmented profits, do not exceed 10 million, and the company was not large in the previous chargeable accounting period. Quarterly payments not required in those situations. Have a little read through what we have just said and get to grips, therefore, with the idea of when and for whom we have to make these quarterly instalment payments. So let's remind ourselves, therefore, of when it is that a company has to make quarterly instalment payments. Quarterly payments, we have just said, are not required if current augmented profits do not exceed 10 million. That's a huge amount there, and the company was not large in the previous chargeable accounting period. So the usual situation is, if the company was not large in the previous chargeable accounting period, then it will not now be required to make quarterly instalment payments for the current accounting period. The basic prerequisite is we'll only have to make quarterly instalment payments this accounting period if we were large in the previous chargeable accounting period. The only time there, if that will not apply, is that quarterly payments not required if current augmented profits don't exceed 10 million and the company was not large in the previous period. If we were not large in the previous period, but the current augmented profits do exceed 10 million, then at that level, you're going to have to make quarterly instalment payments this period. But otherwise, and I can't imagine that particular issue being tested, as long as the company was not large in the previous period, you will not be required to make quarterly instalment payments this period. So let's just have a little example to illustrate the impact for a company when it changes from the normal due date through to quarterly instalment payments. So let's just base this example on a single company that prepares accounts for a 12-month period. Now, we know, of course, that will mean that we're talking about 1.5 million as the profit limit. So let's say that for the accounting year end 31st of March 16, that the company had a TTP of 1.6 million. A TTP of 1.6 million. We're told it's a single company with no group companies, no related 51% group companies. So the profit limit in determining will we or won't we be interested with the quarterly instalment payments is 1.5 million. Now I've told you there the TTP is 1.6 million. So irrespective of franked investment income, we know that the company is now large. If you are then told that in the accounting year ended 31st of March 15, the company was not large, so imagine that it was a profit of £1 million in the year ended 31st of March 15, with a profit limit still of 1.5 million, the company was not large in that previous period. So it means that for this accounting period, with the TTP of 1.6, not large in the previous period, this profit does not exceed 10 million, therefore there'll be no quarterly instalment payments due for this period. So the tax due at 20%, so times 20%, that will equal a tax liability of, what's that, £320,000. And when will that be due? It will be due, as it's always been due for this company, 9 months and 1 day after the end of the accounting period. So that tax will have to be paid by the 1st of January 2017. So the quarterly instalment payments did not impact on that accounting period. But now we've become large. If we are then estimating large for what is now the current period, the year ended 31st of March 17, let's assume now that we're estimating, we've got an estimated TTP equal to 2 million. So, will quarterly instalment payments now be required for this period? Answer, yes, they will. Were we large in the previous period, the year ended March 16? Yes, we were. The TTP, and with it the profit, exceeds 1.5 million. That means that now for the year ended March 17, given that we're estimating a profit in excess of 1.5 million for this company, that it's large this period and therefore quarterly instalment payments will be required. And what I'd like you to do now is to note down what those quarterly instalment payments would be. That shouldn't be too tricky. TTP 2 million at the single universal rate of 20%, that will be 400,000 divide by 4. 400,000 divide by 4. Shouldn't be tricky, eh? So that therefore will tell you the quarterly instalment payments, and I want you now to note down when that first and then subsequent quarterly instalment payments will fall due. And notice anything there specifically about those dates as compared to when it is you would be paying your corporation tax for the previous year. Write down the due dates now for the year ended March 17, and notice if you see anything about with the timing of those tax payments and the very serious adverse cash flow that the transition from normal due date to quarterly instalment payment system, the effect on the cash flow of the company that will have. So calculate the amount due each quarter and state the dates when it would fall due, please. Okay, so we've agreed that quarterly instalment payments will fall due. 2 million at 20% we said was 400,000, divide by 4 is £100,000 as the quarterly instalment payment that would be due. When would be the first such payment? We start to pay from the 14th day of the 7th month from the start of that accounting period. So the year ended 31st of March 17 began the 1st of April 16. So we know that our first quarterly instalment payment, if I abbreviate to QIP there, our first quarterly instalment payment will be due on the 14th day of the 7th month from the start of that accounting period. That is the 14th of October. Within the year ended March 17 is the 14th of October 16. So look at what now happens. This company will have to now start making its corporation tax payments for this accounting period, the year ended 31st of March 17, on the 14th of October 2016, compared to when will it have to settle all of its liability for the year ended March 16. That will be due the 1st of January 17. Look at the cash flow effect of this. We have to now start paying this year's tax before we've even settled last year's tax. Now that, I think, is a pretty important piece of information to convey to your corporate client. That when you see that in the first period for which you become large, that you are then estimating that for the next period, what is for us now the current period, you will also be large, that means that for that current period here, the year ended March 17, you will now have to start making quarterly instalment payments. The first such payment, the 14th day of the 7th month from the start of that accounting period. That therefore is the 14th of October 16. That is some 2.5 months there before you come to pay last year's liability. That's going to have a serious cash flow effect on the company and is vital information to convey to your corporate client before the event. Again, it's no good coming along to them in October 2016 and saying, oh, what's your estimated TTP for this period? And then they're telling you and saying, oh, that's interesting. So you're now going to have to make a payment of £100,000, first quarterly instalment payment in this month, October 2016. Before you've even settled last year's liability. That's a big change in payment dates. It's important that you actually are able to inform the client of that particular point. Now again, look at the example we've done. Make sure that you're happy with the dates that we've identified. Clearly the further dates after the 14th of October 16, we then go to 14th of January 17, followed by 14th of April, and finally 14th of July 17 there as the remaining quarterly instalment payment dates. But just again, look through that, make sure you're happy with where those dates and numbers have come from. Okay, hopefully now we can see the dramatic cash flow effect in terms of the transition from your normal due date to quarterly instalment payments. Very clearly, therefore, when it comes to such things as the use of loss reliefs, a major objective now, given that there's no differential in tax rates, whatever level of profit, whichever company, as we'll see in a moment, within a group we may be dealing with, then cash flow is going to be a most important issue about gaining relief for the loss at the earliest available opportunity. Think what losses do when applied against profits. They reduce them. Loss reliefs will, of course, reduce profits. So if there was a loss relief that had been available in relation to that accounting period that could have reduced those profits of 1.6 million below 1.5 million. If that had happened, and therefore the TTP and with it the profit was below the profit limit of 1.5 million, then the company would not have been large this period, would not therefore have to make quarterly instalment payments in the next period. And that's going to be the effect that we're going to be looking at in our chapter 22, as we'll go back to in a moment's time, looking at if you can use losses wisely, you may be able to prevent companies from becoming large by actually applying losses under the loss relief we'll know as group relief against those companies, reducing their profits below their relevant profit limit. And in so doing, you can get a huge cash flow advantage. That's going to be a major point as regards the use of losses within groups. So again, if you pause at this particular point in time, and then we will move on, and then we'll start off again by looking at chapter 22 on groups. Okay, so let's now eventually therefore get into the object of this particular set of lectures, chapter 22, corporation tax and dealing with groups. First bit of news in the introduction is good news. Companies are within a group, then each such company must still prepare its own corporation tax computation. So every individual company, whether a standalone single company or a member of a group, will prepare its own corporation tax computation, i.e. we do not have a taxation equivalent of what they have in financial reporting, i.e. consolidation. There is no consolidated corporate tax computation that we need to learn about, that we need to prepare for the group. It doesn't exist. All we have to do is to prepare a normal corporation tax computation for each company within the group. Now, in so doing, we have to take account of certain issues. That group companies will benefit from certain reliefs, most notably what we were talking about but a few minutes ago, that being the ability to group relieve losses. Now, it's not a term that we're familiar with at this point, but it's a very easy concept, I think, to understand. And that is, if one company within the relevantly sized group should make a trading loss, then rather than only being able to use that loss within its own company, it can surrender that loss to other relevant group companies. That means, therefore, we can share out the loss of one company between other companies within the relevantly sized group. So group companies will benefit from certain reliefs, but will also have certain additional rules and regulations placed upon them, such as we will see. When we define groups for taxation, then we have to look at precisely the level of percentage shareholding that exists. Groups exist, of course, where we have one company being a subsidiary of another, the parent company. We talk about related 51% group companies there, for again that basic group structure to exist. So if we've got a parent company with a 51% plus owned subsidiary, there are two related 51% group companies. We know they are in a group. But of course what we may have is several subsidiaries of a common parent. They are all therefore within a group. So we will need to look at related 51% group companies. We already know about that from things that we've said in this particular lecture, let alone in previous lectures. And that will be the first detailed technical point that we'll pick up on. Two types of group structure, however, that we need to identify based on the level of share ownership that will be relevant for tax purposes. The bare minimum to command a group scenario, 51% groups. A parent owns more than 50% of the shares in a what is then subsidiary company. 51% groups and 75% groups. Now, it's got to be said, the more interesting and certainly way more examinable issues arise when dealing with 75% groups, but that's something we'll be talking about and dealing with in detail in our next lecture together. First of all, what are these various groups issues? Firstly, in a 51% group, we already know about, and we'll remind ourselves in a minute, about related 51% group companies. If there are such related 51% group companies, then the effect is to reduce the profit limits for each of the companies. That no longer impacts upon the rate of corporate tax paid, that is a standard 20%, but as we noted previously in this session, when we reduce down the profit limit, it may push various members of our group above that relevant profit limit and mean that quarterly instalment payments may therefore be due rather than just the normal due date of 9 months and 1 day after the end of the accounting period. And as we have spoken of in such detail again in this session, that is going to have a huge effect in terms of cash flow. If they are in a 51% group, then such companies are entitled to join in a group VAT registration. Now again, as yet we've not seen VAT, that awaits us in Chapter 24. But the idea will be that rather than each company being separately VAT registered in its own right and having to submit therefore its own VAT return each return period, that is normally on a quarterly basis, that we are allowed to join companies within an overall group VAT registration. This, as we'll see in Chapter 4, is not compulsory. We get to choose which, if any, of our companies we would actually want to put into a group VAT registration. And for those that we choose to put into such a group VAT registration, we'll then only have to prepare one VAT return, rather than lots of separate individual VAT returns. But more of that, the details of that, within Chapter 24. Another issue, the availability for capital allowances of AIA. We know that AIA is set, at least for our examination, at a standard level of £500,000. However, that level of £500,000 will now have to be split amongst the related 51% group companies there. Each company, I'm afraid, does not get £500,000 worth of AIA. It must be divided between them. How we divide it between them, well, that's down to us to decide, and we'll talk about the issues, therefore, that may dictate how you would choose which companies would take the benefit of the available AIA. We'll deal with that again just a little later. When, again, it'll be next session before we do this, we get to look at 75% group issues, that's the big two when it comes to practical taxation significance and indeed examination significance so far as you're concerned. It brings in the possibilities for such companies within a 75% group, as we will separately define for each of these two issues. That group relief of losses, as we just spoke about, may be available, where a loss sustained in one group company may be relievable against the profits made in other separate group companies. And then also something known as gains group membership. Now that again has rules and regulations. It also has claims elections available. We'll discuss those again next time. That's slightly more complicated than the basic concept of group relief. But the first of those 51% areas, and again one that we know well about, related 51% group companies. When are companies related 51% group companies? Well, we know that. If either one company is a 51% subsidiary of the other, parent and 51% plus sub, or they are 51% subsidiaries, co-subsidiaries of another company. All of those are related 51% group companies. Hence, as we know, a parent company, a holding company, with 3 51% plus owned subsidiaries, parent company plus 3, there are 4 related 51% group companies. Control here is a company is a related 51% group company if the parent company owns directly or indirectly more than 50% of the share capital of the subsidiary company. When is that for it to be a related 51% group company for this accounting period, if that was the case at the end of the previous chargeable accounting periods? If there are dormant companies that have been dormant there through that period, dormant companies are excluded, but overseas companies, yeah, we will include there. The tax implications, the profit limit, as you know. This was the point that we've just spoken about when dealing with quarterly instalment payments. the profit limit of 1.5 million used to determine if a company is, as we called it, large and therefore required to make quarterly instalment payments, that now will be divided between the number of related 51% group companies. So, little example here in terms of example 1, which again you should be able to comfortably deal with given what we've already said and dealt with within this session. A Limited owns 100% of the share capital of V Limited, F Limited and C Limited. Therefore, that is a parent and 3 wholly owned subs. There are 4 related 51% group companies. Therefore, divide your profit limit of 1.5 by 4. And this company has a TTP of £400,000. Is A Limited a large company for purposes of making quarterly instalment payments? Now think about that in the context of what we have already said and write your answer down to that, please. Then check through with the model answer in the back. So the calculation needed here to be able to determine whether or not A Limited may be required to make quarterly instalment payments in relation to any given accounting period. We have a profit limit of 1.5 million, which we now divide by the 4 related 51% group companies. That therefore, when we divide out, will equal 375,000 as the profit limit. The profits here, well, even the TTP is 400,000, so definitely the profit is at least 400,000. That is above 375. The company therefore may be required to make quarterly instalment payments. Now I have to say there may, and if you read through the answer, you'll understand why. If we were not large in the previous accounting period, then we will not be required to make quarterly instalment payments for this accounting period. If, of course, we were large in the previous period and now have estimated large for this period, then quarterly instalment payments would indeed be required. If, as I said, we were not large, our profits did not exceed 375,000 in the previous period, then this is the first period in which it's arisen, well, as compared to last period that is, and on that basis, then although no quarterly instalment payments were required for this period, they may then be required for the next accounting period. And they will be required for the next accounting period if, and that if is if we're estimating, of course, that our profits will be in excess of the profit limit for the next accounting period. If so, then for that period the quarterly instalment payments would fall due, and we'll have to start paying that period's tax from the 14th day of the 7th month from the start of the accounting period. Again, go back and revise on your quarterly instalment payments and indeed everything else that we've done in this session, because we'll now bring this one to a close, and at the beginning of the next session, therefore, we'll continue on with our study of groups.